Hello again. This is a study sheet for Chapter 3 and adjusting entries. When you finish Chapter 2, you will be ending with unadjusted trial balance, and that is a trial balance where the accounts have not been adjusted, and Chapter 3 will introduce you to adjusting entries. There are 5 categories of adjusting entries, and I'll talk about each of them briefly. The first one is for prepaid assets. A good example of prepaid assets would be supplies or prepaid insurance. When you buy supplies, you might buy a big bulk amount of supplies and you put them in the cabinet, and let's say you buy $500 worth of supplies. At the end of the period that you're doing your financial statements for, you would look in the cabinet and say, okay, I bought $500, how much is left? And you might decide that 20% is left, or $100. So that means that you've used 80% of the supplies. So the adjusting entry is going to adjust the supply asset account that's sitting there with a $500 debit balance down to the actual amount that's in the closet, which is $100. So what we're going to do is we're going to take the asset, we're going to reduce it with a credit, and we're going to increase supplies expense because we use the supplies. The used supplies become an expense. So we will debit the expense account and credit the prepaid asset account for, in this case, $400 for the expense and credit supplies for $400 because we've used $400 of the supplies. This would also pertain to insurance. When you buy insurance, you buy it for maybe 2 years, and after the end of the accounting period, let's say it's 1 year, then if you paid $1,200 for a 2 years policy, at the end of the year, you've used half of it, which would be $600, and so you would have to record the adjusting entry for the amount used. So that's how we would adjust for prepaid assets. The next item is an accrued expense. An accrued expense is a owed amount but not paid or recorded because the due date is in the next period. So one item that is a good illustration of this would be wages or salaries. When you are paying individuals, let's say you pay your employees every Friday. That means that every Friday they receive a check. And let's say we pay them $100 a day. We have one employee, so every Friday they get a check for $500. However, this particular accounting period ends on Wednesday, so that we're not going to pay them until Friday, which is the beginning of a new accounting period. So what we have to do is prepare an adjusting entry to indicate what we owe the employees on Wednesday the 31st, but we're not going to pay them until Friday the 2nd of the new month. So we would owe them $300 for Monday, Tuesday, and Wednesday, so we would debit wage expense for $300, and we would credit wages payable for $300, and that would be the adjusting entry. So once again, we are adjusting for wages that we've incurred but not yet paid because the due date doesn't happen until the next month or the next accounting period. The next item is accrued revenue. And accrued revenue is very similar to an accrued expense, but it's the opposite of an expense. It's a revenue. It's coming into you. An example of revenue would be a receivable. One good example is interest on a bank account. You get interest on a bank account at the end of the period. So if the month ends on the 31st, you're going to receive the interest sometime the next month. So this is revenue that you've earned in the form of interest, but you're not going to receive it until the next month because the bank pays after the end of the accounting period. So once again, this is revenue that's been earned, but it's not recorded and has not been received because the due date is going to be in the next accounting period. What you would do is you would debit the accounts receivable account for the amount of interest coming in, and you would credit the revenue account for the amount of interest you earn. So even though you haven't received the interest, you have earned it because all you have to do to earn interest is wait till the end of the period and leave the cash in the bank. The next area for adjustment is unearned revenue. And unearned revenue, like I mentioned before, is revenue you've received in advance of doing any work, and it's recorded as a liability. So in this case, the liability is going to become revenue once you've earned it. So if you've received a check for $500 for services to be provided, and at the end of the accounting period you have provided half of the services, then you have earned half of that $500. So what you would do is you would debit unearned revenue, which is a liability, so you're decreasing the unearned revenue, and you would credit revenue account for the amount that you have earned. So you would debit unearned for $250 and credit revenue for $250. So once again, this is an adjusting entry for unearned revenue. And finally, the last area of adjusting entries is for depreciation, and that's a decrease in the usefulness of the asset. So when you think about long-term assets, we're talking about buildings, machineries, automobile, trucks, all of those, you pay X amount of dollars for them, and then you know that they depreciate, but what you're doing is you're spreading the cost of the item over the life of the item. In Chapter 2, all you need to know is that the depreciation amounts will usually be given, and so if they tell you what the depreciation amount is, you would debit depreciation expense for, let's say, $1,000 and credit accumulated depreciation for $1,000. And normally we would have the account name. So if we were depreciating a building, we would have depreciation expense building for $1,000, accumulated depreciation building for $1,000. Now, accumulated depreciation is a new type of account called a contra account, and what that means is it is deducted from its fixed asset account. So when you do a balance sheet, you would show the building account at its full cost, and then you would subtract the accumulated depreciation from that to show how much of the cost has been depreciated. And the journal entry is depreciation expense and accumulated depreciation. This is just a brief overview of the adjusting entry process that you will go through in Chapter 3. Once again, this form is printable, and you can use it to help you solve the exercises and assignments in Module 2.